So we are able to see that what is on the board. I think you can see very well. So you are able to see. Yeah, you're able to see. Now let's take our question here from advanced financial management from April 2023, question 3C. Question 3C. Now remember we are doing chapter 2. I'll remind you what is in chapter 2. You may have forgotten what is in chapter 2. In advanced financial management, what you have is a portfolio viewing and analysis. What is covered is things like capital market line, CML, then capital asset pricing model, Capm, SML, that is security market line, then APM, arbitrage pricing model, and then evaluation of portfolio performance, that is Trainer's measure, Sharpe's measure, Jensen's measure, appraisal ratio measure, information ratio, then Modiglian and Modiglian. Okay, so that is what we are doing. Now, we want to take an example here to illustrate arbitrage pricing model. I'll compare that arbitrage pricing model with capital asset pricing model. And the capital asset pricing model, you have done this one from ATD financial management, that is the intermediate. So Capm, we do not have much problem with. The item which is new at this level is arbitrage pricing model. Now we get some differences when we are doing the viewing. The differences between Capm and APT or APM. And so the major difference is that Capm is a single, remind me of what?
It is a single factor model.
Yeah, single factor model. But arbitrage pricing model is a multiple factor model. So you remember when you are calculating, or in other words, in your formula for Capm, you usually say risk-free rate plus beta multiplied by RM minus RF. The whole of this part is known as what? Is it the risk premium? Yeah, the risk premium. Risk premium. Beta, you said that beta measures what? There are two types of risks, we know that. Systematic and unsystematic risk. So beta measures systematic risk. Yeah, that risk which cannot fully be diversified. Okay, so for Capm, you just be taking risk-free rate plus beta multiplied by risk premium. In other words, market return minus risk-free rate. So that's simple. Now, for arbitrage pricing model, is the same as Capm, only that you are dealing with several factors. For example, if you look at my formula here, the one I have put here, you have seen you take risk-free rate, you plus what? Now remind me this. It looks like Y going downwards. Risk premium. So in other words, market rate minus risk-free rate, you'll be getting this number here. Multiply by what about these ones?
Yeah, the measures of sensitivity of the particular security.
Yeah, the measures of sensitivity. You realize that when using arbitrage pricing model, there are several factors which affect or which are applied in your formula, unlike Capm, whereby you are only using beta alone. For Capm, you only concentrate with beta alone. But for arbitrage pricing model, you are having multi-factor, several factors. You can see you have B11, B12, B13, B14, as much as you will have in the examination. Now let's go straight away to our question. That is advanced financial management, and that is April 2023, question 3C. You have your papers there. Just go there straight away. You have it in your phone. You have it in your phone. but I'll read it from here. You are told you have, I'll read, then I'll show you the figures. You have been appointed as a finance manager of Mamba Limited after evaluating the investment portfolio of the company. You have divided the market into 4 portfolios following 2 dimensions: value, growth, and small. The weight of each portfolio in the index is given below. Now portfolios are here. Now that one I have to present. I have to show. I have to present for those who do not have. Now if it is legible, read for yourself. You read for yourself how it looks like. Will it be legible? It should be. So you are given portfolio, small value, small growth, large value, large growth. The weights 10, 10, 30, 50. Those are percentages. Sensitivity to factor 1. Sensitivity to factor 1 is market beta. The figures are given there. Sensitivity to factor 2 will be price, stock book value. And then you are given sensitivity to factor 3 will be average capitalization. So the question appears, that's how it appears. I think it is legible. Okay, let's just do the calculation straight away. So they are asking us, using the arbitrage pricing theory, determine the portfolio that has the highest expected return. So I have the solution here. You start with a small value. You have seen risk-free rate. You are told after before the end of that question, the risk-free rate is 3%. So we start with this. You can see the portfolios given there. You have small value, small growth, large value, and large growth. Those are the portfolios. So if you see for small value, what will be the return? Remember the formula? Risk-free rate 0.03. You are given there. The risk-free rate is 3%. So 0.03 we plus the market beta 0.87, you multiply by risk premium. The risk premium has been given as 8%, just below there. Risk premium, if you go to sensitivity to factor 1, that is the market beta, you can see the risk premium is 8%. So that is why we are multiplying by 0.08. So you have taken 0.03 is a risk-free rate plus 0.87, which is the market beta. This market beta times the risk premium. You know how we get risk premium. Market rate minus risk-free rate. For this question, they have calculated for you. And then you plus 0.83, the price to book, sensitivity factor 2, 0.83. We multiply by the risk premium, you are given negative 3%. So you multiply by negative 0.03. Then sensitivity to factor 3 is average capitalization. Will be 2 multiplied by 0.40%, which is 0.004%. So if you take 0.03 plus 0.87 times 0.08 plus 0.83 times negative 0.03 plus 2 times 0.004, we get 8.27%. Okay, that is for small value. Go to small growth. Small growth, we do the same formula. We take the risk-free rate, which is 3%, so 0.003 plus sensitivity to factor 0.97 multiplied by risk premium 0.08, that was 8%. We plus, we go to sensitivity to factor 2, the price to book. What do you take? 0.33 multiplied by negative 0.03, then you plus what? 2 times 0.004. You sum up, you get 10.57%. That is for small growth. Go to large value. The same formula applies. Risk-free rate for large value. Risk-free rate does not change. It's the same. It's 3%. 0.03. We multiply, not multiply, we plus. We plus what? 0.92. That's the market beta. Then you multiply by risk premium, 0.08, that is 8%. We plus the price to book is 5 times risk premium, negative 0.03, that is 3%, plus the half range capitalization, that is sensitivity to factor 3, 20 times 0.004. That was 0.40%. You sum up the figures, you get 3.36%. Then the last portfolio is large growth. The large growth, you start with risk-free rate, which was 3%, that is 0.03. 0.03 is here. You plus market beta, that is sensitivity to factor 1, which was 1.12. You multiply by 0.08, that's the risk premium which is given. Then you plus, you look at sensitivity to factor 2 for large growth is 6. 6 times risk premium, negative 0.03. Then you plus, you go to sensitivity to factor 3, which is 22 times risk premium for sensitivity to factor 3, 0.004. So those figures are all given there. You sum up, you get 2.76%. The question was, using the arbitrage pricing theory, determine the portfolio that has the highest expected return. So you have the analysis here. For small value, 8.27, small growth, 10.57, large value, 3.36, large growth, 2.57. So the answer, which one do you expect to have more returns? Obviously, 10.57, the small growth. So that was the answer for that. That is how you could have gotten the 4 marks given there. Okay, that's the end of that. The next part, so that is an arbitrage pricing model. So remember, APT or arbitrage pricing model is a multi-factor model where the rates are affected, or the rate is affected by several factors. As you can see in our formula, it can be affected by inflation, interest rates, GDP, prices of oil in the international markets. Several factors can affect your interest rate when you are calculating any rate using the arbitrage pricing model. So remember the formula as it appears in the board. So we move away from there and we answer number 2, where we are told the portfolio that would maximize your return if you decided to use capital asset pricing model, Capm. We said the major difference between APT and Capm is that Capm is a simple factor model that is mostly beta. Is always beta, which affects the interest rates. Is a single factor model. But APT, arbitrage pricing model, the rates can be affected by several factors. So here, when we analyze this question using Capm, we just stick to this formula. It does not change. The risk-free rate will be 0.03 or 3% as it is given. You plus beta, beta will be given. You say beta measures the systematic risk. Then you multiply by risk premium, market rate minus risk-free rate. And this risk premium has already been calculated for you. So quite simple. Okay, if you go to a small value, you will take risk-free rate. You are given 3%. The risk-free rate is 3%. Just the same risk-free rate appearing that we have used in calculating using the arbitrage pricing model. So you take 3. I'm looking for small value. I've written them as 1, 2, 3, 4. So 1 is for small value. So you take 3%, you can write it in form of a decimal, 0.03. We plan what? Beta. Beta, has beta been given? Is there beta?
Yes.
I can't see it myself.
Market beta.
Market, oh yeah, I see it. Market beta of how much?
0.87.
0.87, yeah. Market beta. That is sensitivity to factor 1. Now let me project that. Now this market beta, because Capm, you have shown me where it is. I was not able to see it. If you look at sensitivity to factor 1, you can see market beta. So that is the only column that you use when calculating interest for using Capm. 0.87, 0.97, 0.92, 1.12. That is what we use. So you have helped me to understand. I think I was sleeping. I was dozing. So we are able to see that 0.03 is the risk-free rate plus beta. You know, when you are using Capm, you only use beta. You don't use the price to book or the average capitalization. So you are given beta there. That is sensitivity to factor 1, market beta. So I'll take 0.03 plus, we are saying risk-free rate plus beta is given 0.87 times risk premium, which is 0.08. So I'll get that. Then I go to small growth. Risk-free rate 0.03. 0.03 for small growth. Risk-free rate does not change. Plus 0.97. You look at the sensitivity to factor 1, which was market beta, 0.97. Then I will multiply by risk premium, which is given at 0.08. So the risk premium is not changing. The same. I go to the third one, large value. Risk-free rate, 3% plus 0.92 times risk premium. Large growth, I'll take 3% plus 1.12, the sensitivity to factor 1, market beta, 1.12, I multiply by risk premium. My answers are there. So 9.96, 10.76, 10.36, 11.96. So what is the question? The question was the portfolio that will maximize your return if you decide to use capital asset pricing model. So the answer, give me the answer now.
Large growth.
The launch growth by 11.96%. The launch growth. So that is the answer for that. That's how you calculate those expected rates. Expected rates using arbitrage pricing model as well as Capm, capital asset pricing model. So those are the calculations. So you just need to master the formula for Capm. I don't need to spend much time with Capm because Capm, if you started with ATD, you did it there. If you started with the CPA, you also had it from financial management, intermediate level, and now at this level, you still have it. Capm is there, so you don't need to waste to spend, not wasting, but overspending time doing a Capm. You just need to understand for Capm, you type the risk-free rate. Now, risk-free rate applies to those securities which mostly originate from the government because the government there is no risk of default from the government. Like treasury bills, treasury bonds, what are the others? We have any others from the government? Do we have any riskless securities, which applies when we talk of risk-free rate, is that rate associated with riskless securities like treasury bills, treasury bonds, those ones. So that is it, risk-free rate plus beta. You said beta measures the systematic risk. Yeah, beta will be given. Then you multiply by market rate minus risk-free rate. Or this part is usually, this part, what is the name for that part? Yes, we have risk, that is called risk premium. That is called the risk premium. Simple, risk premium. So that's the formula for that. The rest is substituting. So you can see from this question, Capm, we are only concerned with one item which is affecting that rate. That is a beta alone. For Capm, we are only concentrating with the beta alone. When you come to arbitrage pricing model, there are several factors which can affect the rate, and that is where you have several of them there. So you apply them appropriately. So that is the end of that. That is the end of that. So we continue with our discussion next time. Right. Thank you for listening.